Hey guys, welcome back to the channel. Today we're talking about PAYSAFE stock and why I was wrong. Yeah, I messed up with this one. If you got in pre-SPAC prices, it was $10 a share and it de-SPACed, ticked up to a very nice profit, which would have been a good exit point. If you exited at then that point, well done. If not, then it's now hovering at $4 a share and it has come down a fair bit since then. And analysts at the moment are suggesting that there is a bumpy road ahead for this stock. It underperformed in its most recent quarter. However, on the flip side of that, there is some light at the end of the tunnel, I believe. I've got some analysis here today to suggest that there is some good things and some green shoots coming out of PAYSAFE stock, but there is going to be a bumpy few months ahead to get to the grass being greener on the other side. If that sounds like something you're interested in today, guys, please smash that like button, consider subscribing to the channel, and let's get in there and let's take a look. Hey guys, welcome into the video. Here we are on the PAYSAFE finance page. And you can see that the share price is currently $3.95 and a market cap of 2.8 billion, which is heavily down from where it once was when it peaked in January 2021 at $18.89 and a significant market cap to go with it. This, as a payments provider and e-wallet that it has, is significantly less than all its competitors. I cannot stress that enough. Obviously, it is down at this price for a reason, because it is slightly underperforming at the moment, but other people do agree as well. It is heavily down and perhaps in the oversold territory. So, as you can see, its EPS, it beat in Q2 2021, but has missed in both Q3 and Q1, and its revenue has flattened off slightly, and it isn't actually profitable right now, which is, as the company as it is not unexpected, to be fair. It is still rated between buy and hold, a rating of 2.4 by analysts. The current average is $6.44, a low of $4, a high of $13, but it's currently at $3.95. But as you can see, a whole host of downgrades towards the back end of last year based on it not performing as good as it should. Now when we have a look into why, Diana Blackhorn over at Yahoo Finance has said here that it recently de-SPACed. Its value was 9 billion, and then as we've seen, it's fell 73% over the last year, which is a huge downgrade. Of course, I personally am still holding this company. I've averaged down a position, but I got in at around the $11 start to begin with. So yes, I've come down quite a bit, but at least I wasn't in at the high. So is there reason to believe? Well, it really is now a cheap stock, as they said there, and the management have been buying up shares considerably, which obviously usually is a good sign, and that was sent the share price up 16% when that was announced. So has the Foley touch failed? Well, I still think it's a little bit too early to tell yet with this one, guys. He still needs to have a chance to bed in and start getting this going forward properly as is. This company is still significantly undervalued in comparison to Visa, MasterCard and whatever. And the fintech sector, it has been absolutely demolished, and the payment sector and processors have been absolutely demolished at the moment, which could not come as a worse time for PAYSAFE. The bottom line is, according to this analyst, PAYSAFE right now is purely speculation. I think there's a little bit more to it than that. The company is dirt cheap in comparison to other processors, as I've already said. If online gambling continues to take off in the United States, which most people believe is what's going to happen, then the company's digital sector is going to do far better, and its e-cash system is also going to do far better. A couple of really good news stories for this company, and performance improving with revenue beats or earnings beats, EPS beats, and this share price is going to recover quite nicely. However, at the moment it has been massively beaten up. So another good news highlight here is principal shareholder Canny Holdings purchased 22 million worth of PAYSAFE common shares recently on the 4th of January, which equated out to 5.7 million shares and represents approximately 8.26% of PAYSAFE's United share. So this company obviously has a lot of faith in PaySafe going forward. They were already a shareholder. They've brought this in as an absolute bargain price and increased their position, which is a vote of good news. Again, flipping back over to the bad side of things, there's an upcoming reminder from the law firm that encourages PaySafe investors that lost over $100,000 to get in touch with the firm. Now, that is going to expire on the 8th of Feb. That is a bad news item at the moment for the company, because there's a lawsuit in place that's trying to say that PaySafe and Foley did not disclose everything about the company before they de-SPAC'd, and that has obviously resulted in some significant losses for some investors, especially if they bought in at the $15 to $18 mark. Coming all the way down to $4 a share is a significant long way to fall. So while that's going along, that is going to obviously be a thorn in the side of the company. But once eventually it gets cleaned up and the company gets a chance to actually implement its plans going forward, and its plans to sort out the digital wallet and keep growing the company, then the share price can again get a chance to recover. So over on StockWits, again, I know it's not exactly the most sought after sort of reliable source, but if you read someone here, this guy here, Wall Street Bets Redditor, again, I know the name doesn't exactly scream confidence, but he says Jim Cramer does not understand just how PaySafe is down this low. He says count himself as a buyer, not a seller. The company is losing money, but it's not losing it hand over fist, and it's just sort of, it's not massively underperforming, but it's not obviously outperforming. It's just doing so-so at the moment, and if it can just find another gear and kick that into growth again into the future, especially using the gambling in the United States taking off to do that and resetting its digital wallet, then it can recover massively, start growing the revenue again, and that in turn will fly the share price because it is so low at the moment. And just how are they going to do that? Well, if you quickly dive into the investor presentation that came out on the 11th of November, you can quickly see that the key messages are that there was 19% year-on-year growth in quarter-free profit in EBITDA. They're going to continue to exit the strategy in iGaming and crypto and the eCash. Digital wallet was weaker than expected, we know that, but as a result, they've reset their 21 and 22 outlook. But there is a long-term play in this company if you are here for the long term. There's loads of extra information here of things that they did achieve, things that they didn't achieve, and that is why that caused a slight reset. However, so that's where the projection was supposed to go, that's where it currently is, and it looks like it's going to come down a little bit for quarter four as well, which is why the share price is absolutely where it is. Well, they do have it in hand, they do have a plan available, and they are, hopefully with Foley's guidance, going to kick this up a gear and sort it out. There is some good news stories. If you pull back behind the major bad thing, there are some good news stories. eCash there up 18% year on year, good double digit growth, and integrated processing also up 18% year on year versus 2020. So that is a good news story, and that makes up 70% of revenue, so that is a great asset for the company going forward. So they're looking for 50% revenue growth for 2021 in gaming, and this is exactly what caused the sell-off in the share price originally. So they actually just underperformed in terms of revenue, just underperformed in terms of profit, but actually in EBITDA and cost of services they actually did okay. So this company is just literally just under where it should be, and that is how it should be viewed. And the sell-off, along with the fintech sell-off, along with the processing sell-off, really did absolutely hammer this company's share price. Some might argue perhaps unfairly so, some might argue that the company just isn't performing as it is, enough as it is, but there are some good news metrics right here to be looked at. Yes, the digital wallet is down, but they've got a plan to recover that, and that is good. Again, we have the integrated processing side of things up there. They do have a fair bit of cash on them, so they do have 262 million in terms of cash available, but they do have quite a high debt ratio as well, which is also why the share price may be where it is. So going forward, they've revised the guidance over on this side here from the prior to the current, so they've just brought it down just a smidge. Hopefully they can recover that and actually beat that on the way through. That won't immediately affect the share price massively, because people will just say that you've lowered your target and now you've hit your target. But in the successive quarters, if they can keep beating it, that's when we start seeing a really good recovery in the share price going forward. So this is the plan. This is what actually happened. So the green arrows are the good things, the red arrow is the bad, obviously, but that's what they're going to do going forward. They're confident in their long-term outlook, and that is exactly why the CEO has been buying shares and one of the key investors has been buying shares. They have a clear path forward to address the challenges and unlock the value of digital wallets, and they've obviously reset their 21 and 2022 outlook. So that is what we're looking for going forward. So guys, yes, I was wrong about the company initially, but over the long term I think it will recover, and at the entry price that it's got now, it is a good entry point to get into the company. I think the company has bottomed. It hasn't really dipped any further than the $3.5 to $4 a share, and that is literally rock bottom for this company. As long as it sort of stops the rot, recovers and starts beating on its revenue and its EPS over the next 3 or 4 quarters, at least either getting just over the line or beating it massively, then we'll see some recovery in the share price. At the moment it's just going to plateau and tick along until there's either some really good catalysts, either from the court cases or from revenue growth in the Q4 or into Q1 2022. That's essentially what you're going to have to wait for with this one. You're going to have to be a little bit patient. I for one have kept my position. I've averaged down to around this $6 to $7 mark. I'm considering taking a few more shares on to try and bring that down a little bit more to maybe the $5 mark, and then I'm happy to just sit on that for the long term, for the next 12 months, 18 months, and see where the company goes from there. As I say, I believe that it has bottomed out, so kind of the only way from here is upwards. Hope you've enjoyed the video today, guys. Absolute pleasure to make, as always. As always, I'm honest with what my greatest hits are and what my losers are, and this one unfortunately has been a little bit of a loser, but I haven't seen fit to actually exit the company completely. So stay tuned and see where I end up in the future with this one. Thank you for watching.